Buenos días. Muy bienvenido a este seminario. Las bienvenidas van a ser presentadas por Juan Carlos Llobet, decano de la Escuela de Negocios de la Universidad de Virginia. Para los que no lo conocen, en el pasado ha tenido importantes roles en el servicio público y en el mundo empresarial. Entre otros roles públicos fue ministro del Trabajo y Previsión Social, lo que siempre trae consigo un vínculo con los fondos de pensiones. Y también va a dar la bienvenida a don Rodrigo Cifuentes, que es economista principal en la Corporación Andina de Fomento, CAF, el Banco de Desarrollo de América Latina y el Caribe, y está basado en Santiago. Rodrigo tiene un doctorado en Economía en la Universidad de Harvard. Anteriormente fue economista senior en el Banco de Inglaterra, en Londres. Fue gerente de estabilidad financiera del Banco Central de Chile y gerente de investigación financiera del Banco Central de Chile también. Con esto paso adelante, Juan Carlos.
Muchas gracias, Salvador. ¿Cómo están? Buenos días. Me gusta ver esta sala llena. No puedo dejar de notar, siendo padre de 3 mujeres, que este es un área en la que necesitamos más mujeres, parece, ¿no? De ver la audiencia. Pero gracias a todos por acompañarnos hoy. Un placer tenerlo aquí en nuestra sede de posgrados de la Universidad de Virginia. Quiero empezar agradeciendo a todos por acompañarnos, agradeciendo al equipo que organizó, a Salvador por organizar esta serie de conferencias, al profesor Richard Evans por acompañarnos, un viaje corto, llegó el domingo recién a Santiago y se va mañana en la noche, así que muchas gracias por el esfuerzo. Agradecer muy especialmente a la Red Vial y a la CAF por acompañarnos y por ayudarnos como patrocinadores de este encuentro. La Escuela de Negocios cumplió 70 años el año pasado. Fue fundada en 1953. A pesar de que mis colegas de otras facultades no les gusta, somos muy anteriores a la Universidad de Virginia. La universidad partió a fines de los 80. Y como parte de esta conmemoración de los 70 años hemos organizado una serie de eventos para discutir distintos temas relevantes para el mundo empresarial y para el desarrollo de los mercados. Y nos pareció muy importante organizar esta serie de seminarios, que vamos a tener otro la próxima semana, el miércoles de septiembre, ¿verdad? Ya, sí. Y agradecer a Salvador por esa organización. ¿Por qué este tema, no? La gestión delegada de fondos es muy importante en los mercados. Uno podría como distinguirla de la gestión directa, en la que el dueño de los activos está involucrado directamente en la gestión de los activos. La gestión delegada, como ustedes saben bien, el dueño de los activos le delega a un tercero como mandante la gestión de esos activos a cargo de una comisión, ¿no es cierto? Y la expectativa de tener ojalá buenos retornos a un costo razonable. Esto es muy importante en Chile porque el tamaño de esto ha crecido en todas partes del mundo, como ustedes saben muy bien, y en Chile, Salvador estuvo haciendo algunos números, hay casi 300 billones en gestión delegada de fondos, entre los fondos de pensiones, los fondos mutuos, los fondos de inversión, ¿sí? Eso es casi el 90% del PIB, 87% del PIB. Eso a pesar de que esa cifra cayó después de los retiros, de los lamentables retiros de fondos de pensiones de los años 2020 y 2021. ¿Sí? Este es un tema en el que la academia está haciendo una contribución permanente. El objetivo de estos 2 seminarios es poder ir viendo esos avances que ha tenido la academia, la investigación, cuáles son los conocimientos de frontera, para ojalá poder ir incorporándolo en el mercado de capitales chileno. Y ojalá también que eso pueda alimentar, ser una fuente para la regulación, ¿no es cierto? Los mercados de capitales y la gestión delegada funcionan en un marco regulatorio que tiene que ir actualizándose en la medida que los conocimientos van avanzando también. Así que estamos orgullosos de tenerlo, profesor Evans, aquí en esta discusión. Gracias nuevamente a todos por acompañarnos y espero que tengamos una muy buena discusión.
Muy buenos días. En nombre de CAF, quiero darle la bienvenida a todos. Para CAF es muy importante apoyar esta iniciativa que supone un avance en el conocimiento de temas que son de gran y creciente importancia para nuestro sistema financiero. Gracias, Juan Carlos. Aprovecho de contarles que CAF reabrió su oficina en Chile en marzo del año pasado, después de haber sido uno de sus 6 miembros fundadores en el año 1968 y de haberse retirado luego en el año 76. Hoy CAF es un banco donde sus accionistas son los gobiernos de 21 países de América Latina y el Caribe, más España y Portugal. Tiene colocaciones por más de 36.000 millones de dólares. Y aspiramos a apoyar de manera relevante el desarrollo sostenible de Chile. Quería contarles que en el último directorio de hace 2 semanas, en Lima, se aprobó un crédito, CAF aprobó un crédito por 500 millones de dólares a Trenes de Chile, F, siendo el crédito sin garantía soberana más grande que ha entregado en su historia. Entonces Chile vuelve con bastante importancia en la institución. Sin más, quería darle las gracias al profesor Evans por su presencia acá. Thank you very much for coming.
Bueno, voy a presentar ahora a nuestro expositor principal, Richard Evans. Es profesor del Darden School of Business, Universidad de Virginia, donde ha enseñado e investigado por muchos años. El año 2020 fue elevado al sillón de investigación Donald McLean Wilkinson. Richard Evans obtuvo su doctorado en finanzas en la Escuela de Negocios Wharton de la Universidad de Pensilvania. Sus investigaciones sobre la gestión delegada de inversiones han sido publicadas por las principales revistas científicas del área y también ha sido citada ampliamente por la prensa financiera de Wall Street Journal, The Economist, Forbes y por las agencias reguladoras del mercado de Estados Unidos, la Securities and Exchange Commission, la US General Accounting Office y el Consejo de Asesores Económicos de la Casa Blanca. Actualmente es miembro del consejo editorial de la revista Financial Analyst Journal. Es el director académico del programa IQ Executive del Money Management Institute, que es la Asociación Gremial de Empresas de Servicios Financieros de Estados Unidos. También ha enseñado cursos para profesionales de las inversiones que son ejecutivos de Goldman Sachs, Fidelity, BlackRock, Vanguard, T. Rowe Price, UBS, Merrill Lynch y Morgan Stanley. Así que tenemos un expositor de lujo. No solo eso, ha sido profesor e investigador visitante en las siguientes universidades: Escuela de Negocios Hong Kong and Shanghai Banking Corporation de la Universidad de Pekín, China, en la Escuela de Negocios de la Universidad de Melbourne, Australia, en el Colegio Carlo Alberto, Universidad de Turín, Italia, investigador visitante Santander en Clare Hall, Universidad de Cambridge, Inglaterra, y visitante en la Escuela de Negocios y Economía de la Nova Universidade de Lisboa, Portugal. Así que hoy contamos con su presencia en la Escuela de Negocios en la Universidad. Bienvenido, Richard.
Gracias. Muchas gracias. Hablo español un poquito. Lo siento. Not enough that I could do my talk in Spanish. Now, I admit, when I do these things, Salvador, appreciate that welcome. I'm a humble guy, so I'm always a little embarrassed by them. But it was great to do it in Spanish because I didn't understand a word he said. So for all I know, you think I'm a lowly, I don't know. But anyway, but I'm very glad to be here. Certainly grateful to Lorraine Vial, to the CAF Development Bank, and to Universidad de Adolfo Ibáñez for hosting me on what I think is a very important topic. Now, I want to start with the real basic. And I recognize the people in this room are sophisticated to a degree that you're thinking, why would I start here? At the same time, I want to build up, as we do as economists, the basis for investment management, right? So delegated investment management. So we think investors typically choose between buying individual securities, right? You could put all of your money in LATAM Airlines if you wanted to. I don't necessarily recommend that, but you could. Or you could pool your money with other investors in a fund. Okay, now this pooling is often common, especially for individuals who don't have massive sums of money, in part because they want to diversify their portfolio, right? I want to own not just LATAM Airlines, but Banco de Chile and a bunch of other international stocks as well. I might do it as well because if I have a problem with LATAM Airlines and I own one share, they probably won't respond to my emails. But if I invest with Lorraine Vial and many others do as well, and they own a lot of their shares, they might return their emails and their calls, right? So large shareholder leverage. Now, the reason we're going to talk about most today is this delegating to a professional money manager, right? So when I'm sick, I don't try and solve it myself. I go to a doctor, right? They're a professional. And so many people might have expertise in many things, but perhaps not in investing. And if they don't have investment expertise, they might seek out a professional money manager who does have expertise, who spends every single day, every waking moment thinking about markets and stocks and prices, right? And so that's often our solution. As with many things, we delegate the responsibility, this important responsibility to invest, to someone who has those expertise. Okay, now, in financial economics, though, we think about this giving rise to what we refer to as the principal agent problem. Okay, now what is the principal agent problem? It's just an agency cost. It's a conflict of interest. We have lots of terms for it. But it turns out it's one of the most important issues in all of financial economics. You take the base papers and they have in excess of 190,000 citations. So it's something we think a lot about. Okay, so what is a principal agent problem? The principal would be the retail investor in this case, right? And as we talked about, they may not have expertise to manage their own money. So they delegate that decision-making for managing their investments to an agent who is the fund manager. Now, in this quintessential principal agent problem, we assume two things. One, the agent and the principal's incentives are misaligned. Okay, now it might be that it's costly effort, so the agent, the fund manager, doesn't want to work necessarily. It might be that, the mutual fund manager has a connection to a CEO at a company. And that CEO says, boy, we could sure use some institutional investors right now. And so when that fund manager invests in stock of that company, you as a retail investor might think they're acting in your best interest, but they might not be. Right now, maybe this isn't a big deal, but it is a possibility for concern. The other thing was that the principal cannot perfectly monitor the agent, right? Retail investors have very little understanding of the investment process. And so their ability to make sure the fund manager is acting in their best interest may be difficult. Okay, now, I know there are many fund managers in the room who are saying, what is he accusing me of? So I'm not accusing you of anything. But there are, and maybe infrequently, nefarious individuals, right? And this is the problem, right? So when you have a one or two bad actors, obviously nobody in this room, right, you still worry about how you protect retail investors against those individuals. And so that's what I want to talk about. We're going to talk about how you might solve this problem of a principal agent issue. Okay, so what's the solution? Now, I want to put this in real terms. So I'm going to ask you a question. So I'm going to show you a picture of an individual. And the folks that when we talked yesterday, so you can't answer this question. I want you to tell me, would you, if you were a retail investor, you're investing money, would you trust this man with your money? Okay, there's the man. So you want someone to manage your money for you. Now, at the University of Virginia at Darden, we don't lecture. We teach via the case method. And so I'm not used at all to standing up here and lecturing. Instead, the class participates. All right, so let me ask you, so yes or no, and tell me why. And all I'm giving you is this picture. That's all you get. Okay, so would you invest with this man? Yes, no, why? You would. And why? Why would you invest with him?
Looks like he has some support behind him.
Yeah, you see trading desk in the background, or
it seems like he's carrying some knowledge in his hand.
Yeah, he's got files, paper files, perhaps about companies.
Looks like there's coffee in it.
I love it. Yes.
Looks like an accessible, honest, transparent guy.
Yeah, love it. All of these things, right? Now, those characteristics might make you say, well, no. It turns out you're going to be right, but I'd still love to hear from somebody who wouldn't invest with them. Yes. Okay. You can see the load lifted from his shoulders. He's feeling great. Okay, now this picture was taken from the Wall Street Journal a couple of years ago. This is Will Danoff. So he runs the largest fund at Fidelity Asset Management. So that fund is $120 billion. And in addition, he runs a couple other mutual funds, some separate accounts for institutional investors. In aggregate, he's managing in excess of $190 billion. Okay, now, I appreciate your insights, and I agree with those. At the same time, I look at him, and I see a guy whose tie is from 1970, right, who clearly has not combed his hair in years, right, and looks like, like his skin is so pale, I don't think he's been outside ever, right, and he'll tell you, like I've met, he'll tell you he loves stocks. He eats, he sleeps, he drinks. The dean's exactly right. There's coffee stains on these because he's studying all night and he's drinking, But here's the problem, right? If you're a retail investor investing in this fund, you will never meet this individual. Right? You might see a picture of them, but you're trusting, perhaps, think about it in terms of your retirement income. You're trusting your entire future, that retirement, to this individual and whether or not he acts on your behalf. But you'll never get to talk to him. You'll never meet him. And you have really limited ability to see what he's doing on your behalf. That's the principal agent problem. Now, I, like the dean, although I appreciate your notion, it looks like he just got fired. I would, because I've studied his methods. I understand him, how he thinks about things. I look at his track record, all these things. Right? I have lots more information than a typical retail investor is. But this is the question. How do we make sure this agent acts on our behalf? Now, one of the solutions that's suggested, actually, there's a whole academic literature and US regulatory systems based on these that really looks at four main areas, right? So one are incentives and the determinants of compensation. Can we write a contract with that fund manager to make sure they're acting in our best interest? There's also risk measurement and management, right? This is an alternative form of monitoring the manager, see how much risk they're taking. Are they deviating from the investment objective, from the investment policy? Transparency, right? So what do we make the fund or the investment advisor disclose? And then investor sophistication and education. Now, these are all important. I'm only going to be talking about incentives and determinants of compensation. My guess is in the panel and in our Q&A session, we'll probably wind up talking about those other three as well. But my focus today is going to be on incentives and determinants of compensation. Okay, so broadly, not just asset management, but this principal agent problem, one solution that was proposed by Holmstrom in 1982 is what we call relative performance evaluation, or RPE. Now, there are a bunch of other papers of similar time, Diamond Vrecchia, Green-Stokey, others who introduced something similar, but this is the one that gets the most cited because it has kind of the clearest explanation as to why we might use relative performance evaluation. So what is relative performance evaluation? Imagine I have a fund manager and I can't see their actions. But if I have a benchmark, an index, a point of comparison, that might give me a simple way. Even if I can't see what they do, I have an expectation of what they should do. In this case, they're working to generate a return, and that benchmark gives me possibly a way to say, well, this is what the return ought to be. If you're working hard enough, if you're making good decisions, taking a certain amount of risk, I might expect this return. I should say as well, too, even though we've got Q&A later, don't hesitate to stop me. If you have questions, comments, concerns in the middle, I'd much rather this was a conversation than me lecturing at you. So don't hesitate to raise your hand, and love to hear what you have to say. Now, so that's the idea, right? I've got this benchmark. Even if I can't see what the manager is doing, I can see the manager's returns, which in theory, if they're acting on my behalf, are high, and I have a point of comparison where they should do approximately as well as this point of comparison. Now, the nice thing about this relative performance evaluation is we find it all the place. We find it all over in practice. CEOs, for example. In the US, their bonuses are often based on performance relative to a group of peers that's determined by the board. Mutual fund managers, right? So we have lots of evidence now in the US in particular that fund manager bonuses, right? So an important component of their compensation is determined looking at their performance relative to a benchmark of some sort. Okay, now it turns out, so as an example, right? So specifically in the asset management context, this is from Kevin Park, who's the chief investment officer at MFS. Now, this whole case, any of you who are thinking about compensation, determinants of compensation in this industry, this is my go-to source, right? So it's a Harvard case, and somebody must have had a good friend at MFS, because the amount of detail they gave you in this case regarding, including they do 360 evaluations, they give you the actual form. Right? It's huge, but it has massive amount of detail. If I were an investment management firm, there's no way I would share this information with somebody, right? But if you're thinking about it, they have really intricate, and the case is nice, and it talks about what is the right incentive structure, et cetera, et cetera. So Kevin Park's talking in this case about that, and he says, how do they determine the bonus for their managers? We use a relative benchmark, not an absolute one, because some type of stocks are out of favor, and I want our managers to stay with those stocks, picking the best of the worst. When they come back into favor, MFS will be prepared for the inevitable surge in inflows. So I will pay a manager who's doing a good job in an out of favor fund, but they must stick to picking the best stocks in their respective category. Said, I'm not going to reward a value manager, right? Somebody who buys old traditional dividend paying companies who beat his or her index by including tech stocks when tech stocks are hot. That is cheating. Okay, so why this notion? Why compare it? He's saying, listen, I've got a tech manager, they're going to invest in tech stocks. All right, and the internet bubble or other points in time, tech is going to do really well. Whereas my value manager is going to invest in value stocks, they're going to do poorly. Now, the value manager might be tempted to cheat and start to invest in tech stocks to do better. The problem is there'll come a point in the future when tech will go down and value will go up. And if the value manager is in tech, then both of these funds will go down. So he's trying to diversify across all of their product portfolio. Right? He wants stock funds and bond funds, because when stock's down, bonds are up, and vice versa. And so the client will have something they like at the end of the day. Right. So here's an example. Now, it turns out there may be issues, right? So in practice, we see relative performance evaluation, but for the example, with peer groups that are constructed for CEOs, we have a lot of evidence that CEOs influence that process of who is their peers, right? So you can imagine we take the S&P 500, so 500 largest stocks in the United States. We use that, pick a manager from the S&P 500. We think, well, okay, if I have the manager and their peers, on average, that number should show you that half of the managers underperform their peers, half of them outperform their peers. Unfortunately, you do that with the S&P 500, and this Mike Lemon paper shows you it's like 90% of managers in the S&P 500 beat their peers. Now, how is that possible? Like that should be zero, right? Some should be above, below. Well, it's because those peers, and they have influence on the subcommittee on the board that selects that peer group, right? So this is a concern. Right? RP is great if it's the right benchmark, but if the agent can affect the benchmark, then it might make them look better than they really are, and it stops being an effective tool. Now, it's not just there. In the US, we have evidence for mutual funds. So this paper by Berg-Sensoy finds that 30% of mutual funds have the wrong benchmark, and not just any wrong benchmark. They have a benchmark that's taking less risk than they are. So a manager has this benchmark and beats that benchmark, and we think the difference is alpha, right? The skill of the manager. But actually, the difference might just be taking extra risk. It might not be skill. Now, there's some papers on this. I actually have a paper that's recently accepted at the JFE that it says, actually, it's not as bad as this looks. So this number is wrong. It's substantially lower than that. It's more like 10%. You just have to measure it correctly. So it's still an issue, but perhaps not as big an issue as this paper suggested. Okay. So that's a concern and something we should think about in the back of our minds. Okay, so now the first question we want to ask simply is, in practice, if we have this relative performance evaluation, does it improve performance, right? Can we, retail investors, if they have a manager and the right benchmark, does it help them, do better at the end of the day? So the ideal test would be something like comparing managers who have and don't have these incentives. Okay, now the problem is, there are basically no fund managers that don't have these incentives, at least not in the US. So we see the funds themselves have very few incentive fees, but that's because the way it's structured in the US, you have to have something called a fulcrum fee. It's capped on the top and the bottom. There's potential upside, downside. Very few funds use that. However, the fund managers managing the portfolio, 80% approximately of those managers have a performance incentive. Okay, now it could be fund performance or assets under management, right? So, you think, well, there's some people here, there's 21% who don't. So you could just compare this 79% to the other 21%. The problem is the 21% have things like assets under management, and that assets under management is connected to performance. So effectively, it's another mechanism, right? So they basically all, okay, so what do I do then? I want to see, do incentives, these benchmark comparison, does that improve performance? Well, we're going to do something a little different. We're going to look, since everybody has them, we're going to look at variation in performance specific to incentives. Okay, so what does that mean? I'm going to skip ahead for just a second. So this is back to that MFS case. So MFS determines the bonus of their fund managers. 60% of it is based on performance compared to an appropriate competitive universe. So they're going to use what we call a peer benchmark. We'll talk more about that in a little bit. So that's 60% of the bonus is how did you do relative to your benchmark. Now, 40%, 20% is contribution to the investment process, idea generation, communication, mentoring of the analysts, for example, attitude, information gathering, support of other success. Another 20% is contribution to overall MFS, sales and marketing support. As a fund manager, do you go with the sales team who's pitching your product to institutional investors, supportive of the firm's success, and attitude? Now, these are qualitative factors, right? And so harder to measure. This one's simple. My guess is any of you who are fund managers in the room, you've got a little widget on your computer that shows you your fund return and your benchmark return at any moment. These other ones, they use, evaluations, et cetera, et cetera. So the point here is we're going to come up with a measure that allows us to look at kind of the difference in this. So some funds are going to be 60% performance, 40% contribution. Others are going to be 90% performance, 10% contribution. Others are going to be 100% performance, 0%. So we're going to use that variation to say, if I put more of your bonus weight on performance, do you do better at the end of the day? Okay, now, do you do better or not? So So back to here. So this is the paper with my colleagues Melissa Prado and Rafael Zambrana, who in the JFE, where we compare this kind of manager. So we call this the celebrity fund manager. So I don't know if anybody's seen The Wolf of Wall Street. So this is, imagine, none of you notice who Will Danoff was, which is okay. But imagine, you think about somebody like Warren Buffett, for example, right? We all know him. We think he's an amazing manager. This is one single. Now, there's a lot of other people who help Warren Buffett every day manage his money, right? And so his almost $1 trillion, I think maybe it is over $1 trillion of assets. But we think about that one person, right? Now, other places, Fidelity Asset Management, for example, explains very clearly we have a collaborative approach to manage fundamental and quantitative equity. So they've got teams across multiple different funds. So you get the sense there are some places that have a very competitive approach. One manager, star manager, that manager is receiving a bonus based entirely on the performance of their fund, where other investment advisory firms have a more collaborative, cooperative team, and we say cooperative approach at the end of the day. Now, so it turns out there's a whole two different economic literatures that before this paper had never recognized each other. There's one that shows really extreme competitive behavior, right? So my PhD was at Wharton. So I taught the MBAs there. They were amazing MBAs. Anybody who's a Wharton MBA. The truth of the matter is they were all ultra competitive. I mean, they would have sold their grandma for a few basis points, right? That's how much they wanted to win at the end of the day. Okay, now that's a thing. It's fine. It is what it is, right? And so there's lots of evidence that says managers act a lot like that, incredibly competitive. At the same time, there's also evidence suggesting fund managers are very cooperative, right? So, sharing ideas across multiple funds, right? And, letting the sales staff support one fund that's of greater strategic value from the investment advisor relative to another. And so, on one hand, we had evidence saying, every one of them would, like I said, sell their grandma for a few basis points. On the other hand, it's a cuddly, soft, happy, we all love each other. Everybody cooperates. And so our question was, well, which one is right? So it turns out you find both strategies in asset management in the US. There are the Goldman Sachs of the world, where it's dog eat dog, ultra competitive, and their incentive structure is 100% alpha, right? It's your outperformance relative to that benchmark. That's the only thing that matters. There's other places like JP Morgan that are much more cooperative in nature. So they have, their funds run by teams, overlap of managers. The bonus might be performance to some degree, but it's also, based on something like how profitable is the investment advisor, things that would cause you to coordinate and cooperate with other managers as opposed to just thinking about your own fund. Okay, now, so no judgment on here, but basically we're going to see greater incentives towards alpha, basically this benchmark, and lower incentives with the competitive versus cooperative group. So this is how we come up with these indices to measure competitive. The competitive stuff is focused specifically on your fund, right? My bonus is determined by something that happens in my fund. Whereas the cooperative incentives tend to be most things that are happening more generally across the investment advisor. So what do we find? Well, we find that competitive families have higher performance of 0.23% per year. Now, you might say, well, that's not a lot, and I understand that. But as academics, we're putting a ton of really important control variables, absorbing a ton of the information. If you just did a simple comparison of have this strong competitive versus strong cooperative, the difference per year is about 1.25%. So dramatic outperformance if you have strong incentives about performance relative to a benchmark. Okay, now I hope nobody in this room is surprised by that. Right? We give you a bonus structure that incentivizes you to work really hard on your fund, and you work really hard on your fund. Right? That's all that's saying. At the same time, this and other papers make clear this relative performance evaluation, that method of assessing, incentives and performance works in terms of enhancing performance for investment, for the retail investors in those funds. Now, there are concerns as well. I'm not going to talk about it right now, but we may get into them later. So this competitive structure also has some possible downsides. But like I said, evidence that RPE works in terms of enhancing performance. Okay. So we've got it right now. We know there's evidence of performance evaluation works. So now we want to explore an important aspect of optimal benchmarking, specifically the type of benchmark. Now, there are two different benchmarks we analyze here, a pure benchmark and a peer benchmark. And I think we may be the first people to use this language. So let me give you an example. A pure benchmark consists of securities, right? So the S&P 500 is the most common pure benchmark in the US. right? So 500, largest stocks by market capitalization, market cap weighted. So it's just the stocks themselves. Now, a peer benchmark, on the other hand, peer benchmark would be an aggregate of managers. So in the US for mutual funds, Lipper and Morningstar are the most commonly used. Lipper, for example, a large cap, value manager index will take the 30 largest large cap managers, largest by TNA, and equal weight their performance, right? So we can compare myself to the entire S&P 500, or I can compare myself to the top 30 managers, as it were. Okay, so which one works better? What do we think about that? Well, it turns out the SEC in 1993 started requiring mutual funds to disclose a benchmark, right? So this RPE solution. And it wasn't just they had to disclose a benchmark, it had to be broad-based, which they defined as one that provides investors with a performance indicator of the overall applicable stock or bond markets as appropriate. Index would not be considered to be broad-based if it's composed of securities of firms in a particular industry or group of related industries. Okay, now, in 1993, when the SEC came up with this, just before, they have something called a comment period, right? And the comment period allows you as institutional investors to write in and suggest why they might be wrong, why we should change this regulation. My experience has been the more that industry writes in, the more worried they are about that regulation. So that shouldn't surprise anybody. So at the same time, some people wrote in and said, well, okay, can we use peer benchmarks? And so what we use to assess our managers is their competition, right? It is a large cap manager. We look at other large cap managers. And the SEC said no. And they said no, why? Because they considered and rejected peer indices. They said the index comparison requirement is designed to show how much value the management of the fund added by showing whether the fund outperformed or underperformed the market, and not whether one fund outperformed another. A fund could underperform a relevant market while nevertheless comparing favorably with its peers. So their concern was this peer benchmark could be manipulated in a way to make funds look really good, right? So they said, no, you can't use peer benchmarks. Okay, now, so this is the kind of disclosure the SEC required, graphical, at least in its initial inception, would show you, for example, the fund. This is for the Fidelity Contra Fund. So it's $10,000 invested for up to 10 years. If you've only been alive for 5 years, you'd show 5, but if you've been alive for 20, you'd show the last 10 versus the benchmark. So you can see that $10,000 invested in 2011 would be $52,143 in the Contra Fund, but compared to its benchmark, the S&P 500, it'd be $46,257. Right? So every investor will see this, and typically you find it on the websites of the investment advisors as well. So it's common that investors might make their decision by comparing these two. Right now, what this is just a graphical version of alpha. Right? We see a fund versus its benchmark. That difference, in dollar terms, is effectively the alpha of the fund. Okay, so people said, hey, can we do peer? The SEC said no. The other concern the SEC had was you can't own, or at least without, now you can to some degree, but at that point in time, you couldn't own the index company. So if you are Fidelity Asset Management and you are part owner of Standard & Poor's, you might be able to influence them in a way that would affect the S&P 500, which would allow you to do better than the S&P 500, right? So they wanted them to be independent at the end of that. Okay, now, separate from that, in 2005, the SEC started requiring mutual funds to disclose the nature of fund manager compensation. Now, we don't get the actual dollar terms, which would be incredibly useful. What we do get is the identity of the portfolio managers, the extent of their responsibilities. So I can look and see how many other funds and assets each manager is, and the ownership in the funds and the determinants of bonus compensation. And so things like salary, bonus, deferred compensation, specificity, the criteria on which that type of compensation is based. So we get a lot of information about these determinants, right? So what we have is the scenario where fund investors are investing with some fund family, right? So you can think of this as Fidelity or Lorraine Duval or any one of these, and they see a prospectus benchmark, right? That's that S&P 500. This is the graph that they observe. At the same time, the fund family or investment advisor might be using a different benchmark to compensate the managers. In fact, we find that even though there's no peer benchmarks here, actually peer benchmarks are the dominant benchmark in this group. Okay, so the SEC, remember, was worried peer benchmarks wouldn't be a bad benchmark, right? It would cause these fund managers to not put in enough effort. And yet that's what the companies are using internally to determine the bonus for these fund managers. Okay, so this is what the disclosure looks like. Goldman Sachs mid-cap value. Portfolio managers are rewarded for their ability to outperform benchmark. 3 years, they give us the time period, and then the benchmarks for the various funds, right? Now, these are all pure indices. Now, Marshall mid-cap, for example, they say the same thing, but here, these are Lipper, so these are all peer benchmarks. And then we have some examples where we have both, right? So here, the Harris Capital Growth Fund, so Russell 1000 growth and the Lipper large cap. So they're looking at both to make this determination. Okay, now, so we study for the first time the choice. Right? We already know, or I say, as I read the literature, we know we should assess manager performance relative to a benchmark. The question is, what kind of benchmark? And so, well, theoretically, empirically, we study how does the use of peer versus pure benchmarks for manager compensation affect manager effort, their incentive advisory fees, and their risk-adjusted performance, and ultimately what explains the choice of peer versus pure. Now, the theoretical model is a little complex. I know it's early in the morning and people probably have not had enough coffee, so I'm not going to go through all the details. It's in the paper if you want to look at it. But the intuition is relatively simple. All right, so peer benchmarks actually induce greater effort at the end of the day. So why do they induce greater effort? Well, you know, it's the Olympics right now. I like watching the Olympics, especially the track events. So I have a question for you. Once again, you know, the audience participation. So imagine I've got a sprinter who's running by themselves on a track versus a sprinter who's running against a bunch of other runners. Okay, so that same sprinter by themselves versus with other runners, when do you think they're going to run fastest? By themselves or with the others? With the others. Why? It's our nature. Human nature, right? Now I find this in my own life. So I'm not a swimmer per se, but I swim for exercise. And so I'm over at the pool at the university, I'm swimming, and someone can get in the lane next to me, and it can be anybody. Right? It can be a college kid, it can be an old woman, doesn't make any difference who it is. If they're swimming faster than me, I speed up. Why? I don't know. It's not a race. I don't have to, but I'm like, oh, and then they speed up. It turns out they'll respond and speed, and then I speed up a little more, and you have, you know, possibly, you can think of this as a virtuous cycle because we're now both going faster. By the end, I can't get out of the pool, which is part of the problem. But there is something, you know, it's true. Now, it turns out the research on athletics in particular suggests it's not true for everybody, right? People have to have a competitive mindset. But there are many, especially professional athletes, who do much better in competition than they do by themselves, right? On the track, in the pool, wherever it happens to be. Now, it turns out that's the intuition for so what we see is like fund manager can be compared versus the S&P 500. Now, if you work harder, the S&P 500 doesn't respond. It's just a pure benchmark. It's the 500 stocks, they do what they do. But if I work harder and I'm compared to a peer, I might have this synergy where that peer then works harder, which makes me work harder, which makes them work harder, so on and so forth. Right? So the model says, look, as opposed to the SEC's concern that a peer benchmark would actually be worse, the model says, actually, this should induce greater effort on the part of fund managers. That's exactly what we see. So we find 21% of funds use peer benchmarks, 29% use pure, 50% use both. So overall, there's 71% of funds that are looking either entirely or partially at a peer benchmark. So what do we find? The peer benchmark is harder to beat than a pure benchmark. And compared to pure benchmark counterparts, the pure benchmark compensated funds, they exhibit greater portfolio activeness. Right? So evidence that these fund managers are working harder to identify new stocks, et cetera. And they charge higher management fees and expenses, but even after that higher management fee and expenses, there's still net of those fees, superior performance for the investors themselves. Question in the back. It's a good question. So I don't know about the research on sports science. Here, we find a pretty healthy competition. So the nice thing about this, as opposed to a race, is there's a labor market. Right. So if you're the fastest guy, then your services might be in demand from others at the end of the day. Right. And so the incentive, the other thing too, is the incentives are so strong. So I have a separate paper where we can actually look and see whether or not fund managers are working on the weekend. And what we find is, not surprisingly, those with greater incentives, they spend a lot more of their weekends working. Right. So they're downloading 10Ks or other filings from the SEC website because we can monitor. Now, I always hesitate to mention that paper because it makes me sound like I'm Big Brother and I'm monitoring everybody, which I'm not. I try, we're very careful. I don't know the names, et cetera. At the same time, so we find pretty healthy competition, right? So amongst managers, And the other thing is, if you're the very best in this space, mutual funds, chances are you go off and do your own thing. So you actually leave the competition. And it might be a venture capital, private equity, hedge fund, private assets, where compensation's even better at the end of the day. Oh, yeah, go ahead.
Not like a long race, but like a mechanical rabbit race. The benchmark is moving.
It's true. Now, the thing is, both from an investor perspective, so as a retail investor, they tend to not see. So coming back to this is such a great question. So coming back to this diagram, we have good evidence they do not see this, right? So where is this? It's disclosed in a very obscure filing called the Statement of Additional Information. I mean, I'm a researcher who looks at tons of these. I know where to look, and I still have a hard time finding it. Right? So we have good evidence that they don't see this at all. They do see this. And so what does that mean? It means these fund managers are thinking about the other managers, but they're also competing relative to that S&P 500. Why? Investors are going to look at, this picture and make their determination about where to invest based on this at the end of the day. Does that make sense? So the S&P moves around, right? But it turns out the peer benchmarks can be correlated with the S&P, and the pure benchmarks, and the individual managers can be correlated with the S&P, right? But since the peers will slightly outperform that S&P, then that manager has even greater incentives. So I guess part of the assumption is these fund managers are not moving prices in the S&P 500, or at least not enough to affect the returns, is the thought. But yes, come on.
If you have identified any difference between portfolio managers working for a boutique or a company where they own part of the company,
yeah,
or working for a large investment firm. And the other is if you have measured the effect of the fund manager investing in their own money in the fund.
Yeah, great question. Both of those questions. So for this particular issue of peer versus pure, we find, let me show you the other results. So when we think about who uses peer, tends to be investment advisory firms. So it's a little less related to size, but it's more related to what percentage of your investors are institutional. Right, so we're focused on retail investors here in the mutual funds, but we see their separate accounts, we see the other things. And so who uses peer? More often it's folks who have institutional investors as well. Direct sold funds, right? So as opposed to using, in the US, we typically think of, do I buy it directly from the investment advisor, or do I use a financial advisor, broker, some intermediary? So it tends to be direct sold funds. And it's families with greater incentives for competition, right? So when I think about competition, actually, this, the boutique versus not, so it's less about how big they are. It's really what's the composition of your investors, whether you're big or small. And the competitive incentives, like they do this much more with competitive incentives, these are really alpha based, right? So this would include investment in your own fund. So yes, it does increase that. This would include investments, shares of the investment advisor. So we find peers are more likely when my alpha is what it determines, and I'm required to invest in my fund, and that's a larger amount at the end of the day. Yeah, great question. Okay, so now I want to get to I'm really excited for the panel. I hear what they have to say, so I want to get really quickly to that. But overall, when I think about this literature and other papers, I leave with several what I think are important insights. So number one, these incentive structures are complex. Right? We have ways with many different tools to shift towards competitive or cooperative. It doesn't have to be all of one or all of the other, right? So I was asking yesterday, and some of the asset managers said, we try to use a mix of these things, which makes sense, right? But you may want to tilt one direction or the other. Like I often think of, Goldman Sachs versus JP Morgan. They have very different approaches to competition and cooperation that must be optimal for them at the end of the day. So there's many different dimensions, right? Fund versus family, carrot versus stick, right? Do we benefit them or do we punish them? Performance versus revenue versus the labor environment, current versus retirement income. So when I think about incentives, there's lots of dimensions on which we could motivate managers. These are just a few of them. So lastly, intra-manager competition is a powerful incentive. These peer benchmarks embed this incentive. We find, I think as well, this is related to your question about, what happens for the very best. The labor market also embeds this incentive, right? So we have golden handcuffs, meaning some of these investment advisory firms will give shares of the investment advisory firm to the individuals. And yet, like MFS, for example, you receive them at some book value, And then it's, it's not true stock, it's a tracking stock at the end of the day, but it grows with some function of revenue and assets. And so if you leave the firm, you get them, if you leave the firm and go to another investment advisor, you only get them at that book value. But if you leave, retire, or go to a whole different industry, they'll give you the market appreciation of those shares. So there are ways to keep those managers. At the same time, if I'm good enough, I might go to private equity venture capital where I could have much higher compensation at the end of the day. Question?
Bring a better performance.
Yes.
And if you have a very big pricing pressure,
Yeah.
and there is no fee in order to preserve incentives, what is the impact in practice?
So when you say pricing pressure, do you mean the fees for the funds or the?
The investors are looking for low fees.
Yeah, I got you. So, I mean, there's an interesting equilibrium we find globally. Right? So when I think about the impact on fees of actively managed funds, we see the entrance of passive alternatives to differing degrees across many countries. Right? So you can imagine index funds, ETFs enter. So we find two main effects when they, so not surprisingly, when they enter, active fees drop. We also find that the number of active managers shrinks, right? So basically the cream of the crop stays and some disappear. Now, the third effect, which we're just starting to find evidence of now, as the passive grows, the potential for adding alpha grows as well, right? So I have 90% of a market that's passively managed. That means there's going to be lots of mispricing, right? Because those index funds, ETFs, they don't care about the price of those. So I buy them at, buy whatever stock at whatever price the index requires. So on one hand, it causes a winnowing, causes fees to go down and it winnows. At the same time, as alpha grows, actually the remaining managers can then charge a higher fee. So if you have greater skill and are more talented, we find you're consistently able to offer products that have higher fees at the end of the day. So it has both effects. It shrinks that, has higher cream. Now there's more opportunities for alpha, and so then fees can actually expand after that, if that makes sense.
So I work as fund manager selector.
Yeah.
So this is my job.
Love it.
See that in efficient markets.
Yeah.
You have usually very concentrated markets, and the benchmark is very low. There's no efficiency, so you get that concentration. It's very difficult to make a difference between.
Yeah, I'm with you. So if your benchmark's 30 stocks as opposed to 500. Yeah. No, it's a really interesting point, and I agree. There's
you might find sometimes one or two stocks weight 15% or 20% of the, so you are taking a huge risk in one sector or one stock.
Yeah, absolutely. So, I think about that, and I think about two things, right? So as an institutional investor, I think about emerging markets, and I'm interested because the alpha is larger there, or potential alpha. At the same time, I recognize with larger alpha is going to come larger tracking error, right? Those are intrinsically related. So I'm going to have to deviate more just because, if I got two stocks that are a major component of the benchmark, any choice to decrease your position of those is going to add pretty dramatically to your difference relative to the benchmark at the end of the day. So greater alpha, but greater idiosyncratic risk as well.
Tend to look very much alike each other.
Yeah.
There's much less dispersion.
Yeah, I got you. That makes sense.
Is there any evidence of one method of comparing fear makes the fund manager takes too much risk?
So the other issue here, and so here it's a little bit simpler in our model because we're thinking about an investment advisor who's monitoring tracking error relative to the benchmark. And so is that true in the US? So about, I think it's 15 or maybe 20% of the filings suggest that your bonus is determined both by alpha and some variation on tracking error. So an information ratio. But my guess is, talking to individuals in that space, I think it's a lot higher than 20%. Right. So as you read what the SEC requires you to disclose, if I tell you I look at performance relative to this benchmark, I might be looking at return performance or tracking error. So as long as I state the benchmark, I don't have to be explicit about the tracking error piece. My guess is the vast majority of these investment advisors' bonuses are determined both by alpha and tracking error at the end of the day. Okay, I got 3 minutes. So in fact, I'm all basically done. So I'm okay with that. But we also may want to hear the panel, and that may raise more questions, et cetera. So last 2 things before I move to the panel, right? So labor incentives. So the last thing here is managers may game those incentives, but the other paper, which I haven't talked about here, we find economic forces discipline. So retail investor monitoring seems to be improving. So one of the benefits of having a BlackRock or a Vanguard enter into a geography is they bring with them a massive budget towards educating both retail and financial advisors at the end of the day. And so I think about exchange traded funds, right, which to be honest are a pretty sophisticated product, yet the demand for them in the US, right, where BlackRock was offering them in the first place, is indicative of how effective that education was. I mean, they went from 0 to 10% market share in like 6 years. I've never seen a product move that quickly and well-developed, mature market at the end of the day. And lastly, is product market competition is becoming more powerful. So these 2 things have effects that would prevent fund managers from choosing an incorrect benchmark just to make themselves look good. Okay, with that, I'm going to turn it over to our panel. Thank you.
Muchas gracias, Richard. Muy interesante. Y ahora pasamos, pido que pasen adelante los 3 panelistas comentaristas. Los presento. La señora Nancy Silva es directora general de Estudios, Estadísticas y Datos de la Comisión para el Mercado Financiero. Tiene un doctorado en Economía del London School of Economics, un máster en Economía de la Universidad Católica de Lovaina, en Bélgica, y es ingeniera civil matemática de la Universidad de Chile. Anteriormente fue directora de estudios de la ex Superintendencia de Bancos y fue economista senior de la División de Política Financiera del Banco Central de Chile. Julio Ruitort es profesor de finanzas en la Escuela de Negocios de la Universidad Adolfo Ibáñez. Tiene un doctorado en finanzas de la Universidad de Texas en Austin, un LLM de Derecho en la Universidad Adolfo Ibáñez y un magíster en Economía Financiera de la Pontificia Universidad Católica de Chile. Ha sido asesor de organismos internacionales como el Banco Mundial, el Ibero-American Institute of Law and Finance, y su investigación en finanzas de hogares ha estudiado decisiones de las personas relacionadas con sus cuentas individuales de ahorro para la pensión de vejez. También ha investigado en finanzas corporativas. Y Josie Banach es gerente de acciones latinoamericanas y socio de la Reinvial. Tiene un máster en Administración de Negocios, MBA de la Escuela de Negocios Booth de la Universidad de Chicago. Anteriormente se graduó como ingeniero comercial de la Universidad Adolfo Ibáñez y se incorporó a la Reinvial Asset Management en el 2008 como analista en el equipo de acciones latinoamericanas. A su tiempo fue promovido a Portfolio Manager, luego a jefe de estudios y en 2020 tomó la jefatura de acciones latinoamericana en la Reinvial Asset Management. Desde 2022 también es socio de la Reinvial. Bueno, lo que sigue ahora es que vamos a pedir primero a Nancy Silva que tome unos 15 minutos para opinar sobre el tema en general, también sobre lo que puso Richard, y después vamos a darle la oportunidad, bueno, los demás expositores vienen después, panelistas, perdón, y después Richard va a tener la oportunidad de responderles a ellos, y después vamos a abrir la discusión para preguntas generales a Richard directo. Así que adelante, Nancy. Como quieras. Paso. En español, porque le van a traducir a Richard. You're getting the translation.
Bueno, muchas gracias por la invitación a la Universidad Adolfo Ibáñez, a la Reinvial también, y a la CAF. Este es un trabajo muy interesante que muestra, que busca donde no hay luz habitualmente, y eso es lo más interesante del trabajo. La comparación de ganancias por incentivos, la discusión de rentabilidad y costo, esto es todo súper atingente a nuestra discusión política estos días con la reforma al fondo de pensiones y la discusión que se está dando en ese ámbito. Yo vengo a hablar desde la CMF dentro del marco de la industria de fondos mutuos, y aquí tuvimos una discusión bien interesante con el equipo porque empezamos a analizar nuestra normativa, la 365, donde publicamos, ¿cierto?, un promedio de la industria contra la cual los fondos tienen que compararse. Y tuvimos una discusión bien interesante si esto es un pure o un peer benchmark. Y después de mucho discutir, llegamos a la conclusión de que no es nada de lo anterior. Es un promedio de securities, pero es un promedio sucio, porque los fondos son muy gruesos, ¿cierto? Dentro de cada definición de fondo hay muchas cosas. Entonces, cuando tomo ese promedio, en realidad lo que me está indicando es mucho ruido. La Asociación de Administradoras de Fondos tiene mejores definiciones, la CMF está trabajando en un cambio normativo para mejorar la clasificación de nuestros fondos, pero aún así, si tuviéramos el promedio de los retornos por un tipo de fondo mejor definido, eso otra vez es un pure o un peer. No es el leading indicator de los mejores managers, porque otra vez tenemos el ruido que comentaba acá nuestra compañera. Tenemos una industria chica, súper concentrada. Entonces, ¿cómo distingo cuáles son los mejores managers? Además, los fondos tienden a emposarse en portafolios similares. Discusión que también estamos teniendo con la industria de fondos de pensiones, ¿cierto? Hay autores que dicen que sí hay diferenciación respecto del benchmark que pone el Comité Técnico de Inversiones, otros que dicen que en realidad no hay tanta diferenciación y que todos los fondos de pensiones invierten en lo mismo. Una discusión similar hay en la industria de fondos mutuos. Entonces, en un mercado pequeño y concentrado como el chileno, ¿cuál es la mejor definición, la correcta definición de un peer benchmark? Desde el mundo supervisor, claramente tenemos que trabajar en mejorar la información que entregamos al público y los indicadores que entregamos al público, pero aún así, ¿cómo hacemos una clara distinción para que se genere la sana, no sé si es sano trabajar el fin de semana en realidad, pero la sana competencia en el mercado para mejorar la rentabilidad de los inversionistas y mejorar la comprensión que los inversionistas tienen? Ahora, otro sombrero de la CMF aquí, cuando hablamos de fondos mutuos en general, pensamos en inversionistas sofisticados, ¿cierto? Que tienen mayor comprensión de conceptos financieros, pero no es tan así. Dentro de los inversionistas de fondos mutuos hay harto retail que no entiende la información que estamos entregando, porque se la entregamos mal, porque es enredada, o porque aunque se la entreguemos bien, no se comprende. Y quiero citar acá un ejemplo de un estudio que hizo una profesora de la Universidad de Chile con nosotros sobre el CAE. Ustedes recuerdan ese concepto, ¿cierto? Esta tasa que involucra a todas las comisiones. Y ella hizo un cruce de información y decía, ya, a ver, ¿esto mejoró realmente las decisiones de la persona? Y los cruzó con datos de educación universitaria de las personas. Adivinen quién hizo más cotizaciones. Los que tenían educación universitaria asociada a carreras de STEM o economía. El resto no entendió nada. Generamos un indicador para mejorar la comprensión de estos datos y nadie entendió nada. Y fueron los mismos de siempre los que hicieron buen uso de esta información. Entonces, ¿cómo de nuevo desde la política pública generamos información que sea útil para los inversionistas? Todos los inversionistas, los bien informados y los menos informados. Porque tenemos este problema de agencia principal y Warren Buffett no trabaja en Chile. Nuestra regulación no requiere que el indicador, el promedio de la industria, sea generado por una tercera parte no relacionada para evitar conflicto de interés. Aún así, se ha dado el equilibrio de que hay una empresa, LBA, que produce la mayoría de los indicadores para los prospectos de los fondos. Otra vez aquí hay una pregunta interesante, porque tenemos nuevamente concentración en el que produce la información. ¿Eso es bueno? ¿Es malo? No lo está haciendo el supervisor. ¿Debería hacerlo el supervisor tiene otros incentivos. Lo hace un privado, que se supone que tiene incentivos de mercado para generar información transparente. ¿Está bien que sea un solo privado? ¿Está bien que sea ese privado? ¿Están los incentivos correctos puestos ahí? Después, sobre los esquemas de compensación, nuestra regulación dice que cuando hay... No habla de todos los esquemas de compensación de los administradores de fondos, ¿cierto? Habla de cuando tenemos rentas variables asociadas al performance de la inversión. Y en ese caso, la información tiene que estar claramente especificada en los prospectos y tiene que ser accesible a los inversionistas y tiene que ser de acceso gratis, ¿cierto? Yo lo pido y me lo entregan. Otra vez llegamos al problema de cómo entendemos estos contratos, qué tan simples son para que el inversionista pueda obtener información de ahí y sacar los indicadores que le interesan. Hasta nuestro mejor conocimiento, no hay estudios en Chile respecto de esta relación de gestión por incentivos y los retornos de los fondos. Y aquí quiero recordar que la CMF tiene abiertas 2 veces al año una convocatoria a proyectos de investigación con académicos. Hay harta información disponible que no ha sido procesada aún y en la que pueden participar. Y acá seguramente el equipo de supervisión estará muy interesado en cooperar en esa investigación como coautor, porque hay mucha administración sensible, información sensible que hay que manejar. Así que atentos a la convocatoria de octubre. Y en la academia solemos ver estos papers que tienen policy recommendations, ¿cierto? El supervisor debiera entregar información. El supervisor debiera influir en la generación de benchmark. Y aquí la pregunta es a Richard y a los académicos de vuelta. ¿Cómo? ¿Cuál es la experiencia práctica que existe en otras economías? Por ejemplo, cuando entregaban evidencia en este y en otros trabajos de que hay gestores que mueven el benchmark, ¿cierto? Publican uno en el prospecto y después lo cambian, entonces siempre estoy outperforming, pero porque hice trampa, porque cambié la información que estoy usando de base. Para el supervisor detectar eso es súper costoso, porque significaría que tendríamos que estar revisando en tiempo real todos los prospectos para ver si de verdad están cumpliendo con la información que dicen que van a reportar como benchmark. Entonces quizás el equilibrio es la zanahoria y el mazo, les pego después. Cuando los pillo no cumpliendo, entonces los castigo, en vez de estar ex ante tratando de darme cuenta de si se desviaron o no. Y aquí está la estructura de incentivo, algo que conversábamos con Salvador antes. Los incentivos no solo funcionan para arriba, ¿cierto? Cuando yo outperform el índice, también tiene que ir abajo. ¿Qué pasa cuando me equivoco? ¿Qué pasa cuando hago trampa? ¿Qué pasa cuando no reporto la información que el mercado necesita? Claramente el supervisor tiene un rol ahí, pero agradecemos guías más prácticas. ¿Cómo podría hacerse? ¿Cuáles son los incentivos que el supervisor debería poner para que ese mercado funcione de manera más transparente para beneficio de la industria? La CMF tiene el mandato entregado por ley de velar por la estabilidad del sistema financiero en beneficio de los usuarios finales. Ese es nuestro objetivo. Y tenemos un rol de supervisor prudencial y también de conducta y de desarrollo de mercado que se complementan en estas áreas. Estos trabajos son tremendamente importantes para que nosotros cumplamos adecuadamente con nuestro rol. Así que nuevamente muchas gracias por compartir la investigación con nosotros y bienvenida a la industria y los académicos que quieran participar en aportar más información relevante para que el supervisor pueda tomar las decisiones correctas.
Aló, bueno, buenos días a todos. Primero que todo, muchas gracias por la invitación, muy interesante, también muy interesante las palabras tanto del profesor como... Y yo tengo un par de comentarios y tal vez hablar de mi experiencia. Particularmente mis clientes son mayoritariamente institucionales, es decir, clientes sofisticados, que tal vez es un poco diferente que el promedio cuando estamos hablando. Y al final, cuando leía este paper, era, para mí súper evidente, eran dos cosas. Tiene que haber incentivos. Y segundo, a tu cliente principal tiene que importarle. ¿Y a qué me refiero con eso? Y lo mismo decía el paper. A un cliente sofisticado efectivamente era más sensible, buscando buen performance, y por lo tanto él empujaba, decía, si yo realmente busco un muy buen performance, voy a buscar, o los flujos van a ir a aquella persona que lo haga mejor, por lo tanto ahí los incentivos están alineados. Yo creo que separando un cliente, digamos, sofisticado versus no sofisticado, ¿cuál es el problema? Por más que genere los incentivos para el manager, si es que a la persona final no es tan sensible eso porque le cuesta, porque es complejo, se rompe un poco, entonces ahí y ahí yo no tengo la respuesta, pero es interesante esta discusión, ¿qué uno puede hacer para efectivamente, tal vez como decía, estar por el lado de la educación? Puede ser, pero no es tan evidente que la persona sea sensible. Y ahí la verdad, las únicas cosas que yo veo que han pasado en distintas industrias donde pareciera ser que pasa, el tema más de una estructura de arquitectura más abierta, que al final se genera un incentivo para que aquellos asset managers puedan tener todo tipo de productos, y si se generan incentivos para ambos lados, y hay que pensar bien en la estructura de contrato, tienden a tener en la palestra aquellos mejores fondos por su propio incentivo y no porque necesariamente el cliente final está buscando los retornos. De nuevo, es algo complejo, pero lo que sí yo puedo decir un poco mi experiencia es que los clientes sofisticados, en nuestro caso son mayoritariamente clientes fondos de pensiones, inversionistas, instituciones europeos, sí son muy sensibles al retorno y exigen. Entonces, nosotros no, si lo ven, nosotros actuamos un poco como deriva este modelo. Yo creo que ese es un punto. Otro punto que comentaban tanto por dos lados, de la concentración del mercado, y también estaba puesto en el paper. En el paper hablaba este Landau effect. Entonces decía, si es que a mí me ven o me ven mi relativo fee respecto a, por ejemplo, un benchmark, el benchmark es conocido, la información está, por lo tanto yo puedo hedgear ese riesgo si quiero. El problema cuando tú tienes un mercado muy competitivo y profundo como Estados Unidos, que yo no tengo idea de los 100 o 200 fondos con los que compito, por lo tanto no puedo hedgear perfectamente riesgo, y dado eso, lo mejor que puedo es, ok, si tengo este incentivo, voy a hacer el mejor esfuerzo posible. Lo que puede pasar en algunas industrias más concentradas es como, ok, tal vez no conoceré perfectamente lo que tiene cada uno de mis peers, pero como es fondos más chicos, más concentrados, menos participantes, puedo inferir mucho mejor, y por lo tanto se genera un poco ese tema, que sé más o menos lo que tiene el resto y por lo tanto se pierde el incentivo. Entonces, yo creo que la única forma indirecta de ayudar al desarrollo de mercados financieros para que efectivamente haya más security, haya más variabilidad y haya como un incentivo, pero yo creo que es un tema que tenemos que ver. De nuevo, creo que es muy distinto dependiendo cuál es tu tipo de cliente. Un cliente sofisticado, por más concentrado que sea el benchmark como es Latinoamérica, va a tener los incentivos para buscar alfa, tener un tracking error que lo recompense, pero el problema sigue siendo un poco más para cuando tienes un cliente tal vez no tan sofisticado, y esa sigue siendo como la discusión. Otro tema también interesante que comentaban, no sé si sirve, pero el tema de los benchmarks, y es cierto, muchas veces uno dice, este es mi benchmark, pero hay o incentivos para poner otro, o simplemente lo hace otra área y no es el manager finalmente que dice, este es mi benchmark, y el problema es como, más que importar, dime, yo soy quien soy, lo importante es cómo te comportas. Me acuerdo de un profesor que siempre dice, dime cómo que te comportas, cómo cobrarías y te diré quién eres. Y aquí, no, pero hablando, porque una cosa es, pensando un poco en la problemática que tienen, es auditar cada uno de los benchmarks que uno está diciendo, oye, yo soy value, soy así, y la otra es simplemente hoy día relativamente fácil. Tú puedes crear regresión, factores, y básicamente cómo covarías con los distintos estilos, y básicamente, y eso es lo que importa, al final, y volviendo al proceso de inversión, yo te puedo decir, yo invierto de esta manera o de esta manera, pero al final los números son importantes. Entonces yo creo que es importante que haya una rigurosidad y un match entre lo que dice uno, los statements que uno dice, y después la data, la evidencia empírica. Hoy día manejo de data es relativamente fácil, uno puede hacer ese tipo de tarea. Entonces, lo comento en general, pero es interesante. Pero yo diría, para finalizar un poco todos los temas que estaban discutiendo, yo creo que la industria efectivamente es muy competitiva, pero el problema es cómo generar esos incentivos para que la persona final, el cliente final, realmente mueva o reaccione ante mejor performance para que se dé un mejor comportamiento. Y el resultado final, por lo menos el paper, además te dicen que el beneficiado final es el inversionista, una cosa que me llamó mucho la atención cuando comparaban el exceso de performance de los peer versus pure. Te decía que generaba un gross alfa de 0,5%, pero el neto era más o menos lo mismo. De hecho, de cierta forma, no se lo estaba ganando el manager, sino el cliente final. Entonces, de nuevo, sí, me hace mucho sentido en general la lógica, pero como hacían los comentarios aquí, en un mercado donde tenga un cliente mucho más retail, ¿qué es lo que se puede hacer para que se genere todo ese camino para que efectivamente se llegue al mismo resultado? Que es decir, un mercado más competitivo, con mejor resultado, donde que al final el que termine ganando sea todos los inversionistas. Yo creo que esa es como la problemática. Así que Eso, muchas gracias.
Bien, respecto a esta discusión que ha ido surgiendo sobre finalmente quiénes están decidiendo y eligiendo los fondos, me referí un poco a algo de trabajo que hemos hecho con algunos coautores mirando el comportamiento de los ahorrantes de los fondos de pensiones en Chile, ¿no? Porque, bueno, ¿qué usan? ¿Cuán sofisticados son? Nancy acaba de mencionar que como que no responden a las cosas a la entrega de información mucho. Y la verdad es que es importante porque más allá de que uno diga, bueno, mi cliente puede que sea sofisticado, puede ser un institucional, si ese institucional está sujeto a que su base de inversionista es muy sensible a cosas que tal vez no son, pueden no ser en su mejor interés, bueno, es imposible, no va a poder ser indiferente a ellos, ¿no? Entonces, por ejemplo, con Félix Villator, Olga Fuentes, Pamela Cel, nosotros miramos qué tipo de benchmarking en cierto sentido hacían los inversionistas, digamos, porque nosotros, con nuestra asignación, nuestra allocation de los fondos de pensiones, y qué cosas reforzaban nuestro comportamiento. Y nosotros decimos, bueno, probemos distintas métricas de sofisticación, desde algo muy simple como el día que yo me cambio o el mes que me cambio de fondo, si es que el fondo al que me fui en ese mes tuvo un retorno positivo, sin ningún tipo de benchmarking, nada, una cosa absoluta como métrica. Y otras más sofisticadas donde uno dice, bueno, fue mejor que desde el que yo venía, fue mejor que un índice más o menos de la clase. Y lo que parecía reforzar más el comportamiento, la confianza en que quizás lo hacían bien, era simplemente que en el mes y en el fondo al que me fue bien, sin importar mucho cómo le fue al fondo del cual me vine, que podría ir incluso mejor, ¿no? Entonces, una cosa muy inocente, que no, como regla de comportamiento, parecía explicar, al menos a nivel del comportamiento de quienes están aportando los fondos de pensiones, mejor sus decisiones de darle inestabilidad en cierto sentido a qué es lo que tiene que estar haciendo la administradora de fondos. Entonces, más allá de que en la AFP pueden tal vez ser bien sofisticados, la pregunta que surge es, bueno, si es que quienes están al final más atrás y pueden estar reaccionando a estas cosas y a la información que tienen y a cómo ven a sus otras oportunidades de inversión, la verdad que es bien importante. De toda esta línea de investigación de Richard, súper interesante el poner mucho foco en tratar de entender cómo se compensa quien está administrando los fondos, más allá de, digamos, la idea de este benchmark del manager versus el benchmark que se publica, y todos estos detalles. Respecto a los incentivos y la idea de tener un benchmark, surgió esta idea: ¿qué pasa si se le está ganando por poco? Estoy un poquito arriba, un poco abajo de mis pares. Y yo acá no tengo buena data empírica, pero sí recientemente en un trabajo teórico que hicimos mirando cómo reaccionaría un asset manager que es compensado con un management fee y un performance fee con algún tipo de high watermark, ¿no? Con esta lógica, bueno, y uno podría pensar ese high watermark en cierto sentido, adaptando aquí, tal vez estamos estirando la cuerda. Bueno, respecto a estos benchmarks, puede ser puro o de pares, y generaba algunas cosas media interesantes. O sea, la idea de como ganarle por poco en el margen, como algo que jugaba un rol bien fuerte, no pasarse por mucho, porque eso me puede después terminar perjudicando. Y también que digamos, convexidades que empiezan a surgir cuando uno está medio lejos, ¿no? O sea, comportamientos de estoy muy lejos de mis pares y ahí medio tal vez tiro la casa por la ventana y la toma de riesgo puede volverse media compleja. Entonces creo que son temas importantes a tener presentes. Mirando un poco, tratando de pensar un poco la industria chilena y la regulación, bueno, está este potencial premio en desempeño neto de costos, que naturalmente si uno piensa en la acumulación por largo plazo es algo que debiera pesar fuerte en esto como un objetivo. Pero al mismo tiempo empiezan a haber estos tracking errors que son cosas que podrían generar tal vez reacciones de si es que alguien ve, oye, entonces tomó el riesgo, vino el tracking error, salió un periodo malo, y que eso sea muy saliente en las decisiones que están al final. Yo creo que ahí hay un balanceo que no sé, que no tengo una respuesta, pero sí creo que es bueno tenerlo bastante bien presente. y la transparencia de la información. Entonces, si nosotros, digamos, como hay múltiples niveles de delegación, entonces, bueno, está el ahorrante final, está como la cara más visible, sobre todo pensando en los esquemas, la parte más obligatoria del ahorro. Me estoy concentrando un poco más en ese mundo, que es donde está el grueso del capital, digamos, de los ahorrantes en Chile. Y dice, bueno, ¿cómo se compensa? ¿Qué transparencia tenemos sobre cómo se está compensando al gerente de inversiones de la AFP, por ejemplo, en este tipo de métricas? Y luego, ¿cómo se están compensando a aquellos fondos en los cuales la AFP está invirtiendo? Que también ahí tenemos otro nivel. Entonces tenemos un encadenamiento de estas cosas. Y mi duda respecto conectando un poco con lo que decía Nancy, bueno, ¿y cuánta transparencia y cuánto va a poder ser usado de manera efectiva por quienes están decidiendo al final? Digamos, tengo mis dudas, la verdad, ¿no? Que a veces una cosa, salvo que pensemos en soluciones un poco más paternalistas, que alguien tome esto y decida, pero tanta información a nivel del inversionista que está al final medio obligado a ahorrar de esta manera y que tal vez no tiene tanta atención o el conocimiento o lo que sea, o está sujeto a un montón de otros tipos de presiones, no, creo que no es tan claro. Cuando, por ejemplo, uno analiza cómo reacciona a la información más personalizada que se entrega sobre proyecciones de pensión, la gente parece ser no muy sensible, salvo un pequeño grupo, ¿no? Tal vez más sofisticado, que se preocupa de ese tema, pero el grueso de las personas no parecen reaccionar mucho. Entonces quizá hay un espacio, pero al mismo tiempo medio riesgoso, creo, de una solución donde quizás de manera más, quizás llamamos paternalista, alguien aprovecha estos insights en lugar del ahorrante final, pero naturalmente eso está sujeto a todo el ciclo político y todas las cosas que pueden salir mal a ese nivel también. Digamos, cerrando un poco, la importancia de tener claro cómo se paga a quien uno delega decisiones, creo que es muy importante, la conexión con el esfuerzo y si ese esfuerzo se traduce en desempeño. Es refrescante ver buena data, buen trabajo de eso que muestra las conexiones. Que también uno podría ser a veces un poquito más escéptico y creer que al final más esfuerzo no necesariamente se traduce en performance. Hay mucha competencia, no estás solo, entonces si todos están haciendo máximo esfuerzo, que queda para el inversionista al final, es difícil, hay que encontrar esos lugares donde hay algún tipo de ineficiencia. Pero bueno, muy valorable toda esta línea de investigación. Creo que sí es importante considerar y darle una vuelta extra a la diferencia entre estos inversionistas más sofisticados y menos sofisticados para sacar más provecho de esto.
So I'm grateful to Nancy, to Yossi and Julio. Excellent thoughts and great translation. So whoever was translating for me, thank you. I understood every word. That was perfect. So first off, so Nancy, I agree. Working on weekends is not healthy. And it's interesting because I presented that paper in Zurich, and the European audience was like, "This is the most American paper I've ever seen." Because you're saying working on weekends is good. And I'm like, I'm not saying that. I'm just saying if you have stronger incentives. I mean, we literally see people spending more time. Like I said, it may not be healthy, maybe it's not a good thing, but they do work harder, and that actually translates into better performance. The other interesting thing is I presented that paper in Hong Kong, and their reaction was, wait, there are places where people don't work on weekends. And so it just depends on where you are in the world and what the reaction might be. But no, so it's really, this issue of small market, I think, is a really interesting one, right? And I don't know the answer, but I was thinking, so it could be small market, right? That might be why you have so much herding or concentration in the managers. It also could be incentives, right? So I can think of a couple of studies that would be useful, not about Chile, but one about Brazil, for example, that looks at local managers and foreign managers. And so you'll find pretty consistently the foreign managers from countries with stronger incentives. So think bigger bonus, more weight on the alpha. They'll deviate more. They'll have more tracking error at the end of it. Now, the other study that looks at something similar looks at sub-advisors and advisors, right? So you can imagine the same investment advisory firm is managing their own fund in a country. And this was across many countries. So Chile maybe is included in that study. I'm not sure, but they manage funds in their own country.
And then they also manage funds in their country for an international, for a foreign investment advisory firm who's looking for local expertise. So the nice thing there is I've got the same managers, right? It's the same people, but they have two different incentive structures, right? So they typically have, in this case, their local incentive structure was bonus related, whereas the foreign one did not have a bonus component. And so, or at least a smaller bonus component. And so you find them, not only did they outperform in their own fund, right? That may have some other reasons as well, but they actually were taking more risk in those own funds as well. So it could be small market. I'm not discounting that. I do think we got to be careful because that's one hypothesis. An alternative is the incentives are not strong enough to get people to deviate. Right now, so when I think about the other things, so transparency and education, I could not agree more. So the SEC many years ago tried this experiment, right? So the prospectus for US funds is 70 pages long. Unless you're a lawyer, you have no idea what's being said. I mean, it is just a beast. And so they tried something they call the summary prospectus and try to simplify, put the things that matter most, put them right in front of investors. And I don't know if anyone's read the research, but basically it had almost no impact at all. Now I compare and contrast that with BlackRock rolling out the exchange traded fund. And it's amazing. You can literally see in the US data as they were advertising and educating financial advisors, et cetera, you can see sensitivity of investor flows of their decisions becoming more and more tightly connected to the alpha relative to the correct benchmark. Now, they had a lot more money than the SEC did to educate, right? I understand that. They also had an incentive. At the same time, transparency without education is worthless. You disclose 10 more things, and if investors don't know which numbers to look at, you won't do a single thing. So I agree, and I feel your pain. I talk to the SEC about this all the time. And lastly, you mentioning that the CMF has a lot of information, you'd love to collaborate. I don't know if I need to come in October, but if I do, I'll be here.
You can apply.
I can apply. Okay, good. I love it. I mean, this is actually the most important way to do this because we have questions, right? And we'd like to know, is it the small market thing? Is it insane? And finding details, nuanced differences might help us be able to tease out those two effects at the end of the day. Okay, now Yossi's point, I also could not agree more. Institutional investors are amazing monitors. So I have another paper that looks at mutual funds in the US where the same fund manager is managing a mutual fund and then a separate account version of the strategy for institutional investors. Now, there are a couple of legal precedents in the US that your mutual fund and your separate account, if you're managing, they can differ based on fees, right? So there can be lower fee for one, higher fee for the other. And performance can differ for operational reasons, but it can't differ for other reasons. So if it did, the mutual fund investors could sue the institutional. And what we see is these mutual funds that have a sophisticated institutional investor monitoring, they're much better behaved. So lower agency costs, actually the fees come down, they're more likely to have the right benchmark, and performance goes up at the end of the day. So we can look at a fund before and after the institutional thing gets open. And as the institutional component grows, you find they're excellent at monitoring. So market mechanisms that could more closely connect those two might be a way. Like if it's hard to educate individual investors, if you can connect the existing products to these institutions who are monitoring, who are already educated, who understand the importance of alpha and tracking error, et cetera, you can have positive spillover benefits. At least it has in the US. The other thing is, generating incentives so that the retails are more closely monitoring it as well. And in particular, how the surplus is shared. So I'm with Yossi. This was one of the things that surprised us, but excited us in that, we often assume as an economist, the scarce resource, so the thing that's in highest demand, always goes to the person with skill, right? So I could imagine a world where peer benchmarks make managers work harder, they generate some additional alpha, and they keep all of that in fees. To be honest, that's kind of what I expected. That's as an economist. But that's not what we find. We actually find the majority of that alpha gets passed on to these retail investors. So the managers are better off. They get a portion of it, the manager/investment advisor, but the bulk of that is actually passed on to the investors, which I thought, like I said, I was surprised by, but pleased at the same time. Now, your point about herding and risk differences is really true, right? So, but I look at, so I don't understand perfectly the pension fund structure here, but I do think about, we think about carrots versus sticks, we think about upside versus downside. And we know from the models, if you focus on a downside, like you do poorly, you do worse than this, that is way more likely to encourage herding than if we have an upside bonus at the end of the day. So the models are clear about this. So it could be the small market, right, that's causing that everybody's the same, they're very close, they're tightly connected. It could also be the incentive structure that's applied to the largest funds, right? If it's downwards, tail end, and you're only punished for downside, there's no real benefit for upside, you're way more likely to hurt. And so you'd see this very concentrated, every manager looks the same kind of result. So I can't say for sure that's what's going on here, but like I said, the models are very clear about that. But most of all, I mean, what great insights. So yesterday and, the folks I've met today and talking to everyone, I think I've learned way more from all of you than I've taught you. So I think my presence here, I've failed. At the same time, I'm super grateful. Like, this has been awesome. So I really enjoy it. Okay, but any questions, comments, any responses, any of you to that?
The role in the UX of companies like Morningstar, education, and well, we have some we spoke yesterday about different structure because in Chile, banks play a huge role in distributing funds. The US is more open architecture.
Yeah.
But what's been the role of Morningstar?
So up until, I want to say late 90s, retail flows were more correlated to Morningstar stars than any other metric by a long shot. And it's why they'd given people a relatively simple way, and you can disagree with their metric, I do. At the same time, it's highly correlated with what I think would be the right metric. So they gave people a simple way to understand in risk-adjusted terms, this is a good investment strategy. So third-party providers are incredible. Now, you always worry a little bit about what we call regulatory capture. So Morningstar makes money because T. Rowe Price and Fidelity and Goldman Sachs and JP Morgan, buy their services to advertise their stars on their page. So there are conversations that occur, right? There are times when I said, you really should report this. And I'm sure their client, I don't pay them any money, but their clients do. And their clients would say, we'd really rather you didn't. So my guess is sometimes even though they're third party, sometimes they're influenced as well. But, simple, easy, heuristic rule of thumb, stars, right? I mean, it's so straightforward. In fact, most people at that point would pick their restaurants and their mutual fund the same way, right? And that's not a bad thing, right? If we can simplify it. So, yeah, over there.
Yeah.
About the size of the incentive.
So in the US, this is really important. Now, we don't know, the institutional side is a little bit more difficult. In the mutual fund filings themselves, they don't tell us in most of it. There are some that give you a sense. This MFS case is nice and they explain it explicitly. So MFS was on the more cooperative structure. There was a little less on bonuses, but so base salaries were quite nice. And then bonuses would be somewhere between 0.5 and 20 or 30 times base salary. Right, so the upside, so you think about deviating, if I give you a big enough incentive on the upside, people will deviate. Now, maybe they'll deviate too much is the problem, right? And then they're holding one stock and that's all they're holding. The tracking here is huge, but it plays an important role and those incentives are really large in the US. So you go to hedge funds, private equity, venture capital, it's all bigger than it was for those mutual fund managers and it's very large there. So, and other people have answers too. I'm happy to hand off.
One question here. One of the things you mentioned is that incentives is the key role here, plays a key role in why peer-based benchmarks does better than pure benchmarks. But what if you use a subset of funds that are pure benchmarks but have better incentives with as you mentioned, performance fees? So what if I take these funds that use performance fees and compare it to the peer benchmarks? How do they fare up with the peer groups?
Okay, so the question is, instead of comparing funds with pure and funds with peer benchmarks, take the funds with peer benchmarks, but I wasn't clear about what am I comparing to them? What kind of funds?
Use the peer benchmarks with performance fees against the peer group.
Okay.
So you have a better incentive on the fund versus index, and you maybe.
Oh, I got you. Right. Okay. Yeah, that's a really good point. Now, so one thing we can do to assuage your concern a little bit is we see not a lot of movement, but we see some movement across investment advisors. So we do an analysis where we take a subset of them where you've got the peer and the pure and they switch the benchmarks. So our assumption is over that time period, the actual size of the bonus, et cetera, is not changing. And yet we find as you go from pure to peer or peer to pure, so if you go from peer to peer, performance improves. And if you go from peer to peer, performance gets worse. So it's our best estimate because we don't know the exact amount, but we can say, here's a family, we're assuming the bonus pool stays the same. All that changes is the point of comparison. And around that change, we still find our result. Yeah, it's a great question, though.
Hello, good morning. Thank you. Congratulations for your lecture. Fantastic. In Chile, we don't have a big voluntary investment market. The biggest market is a mandatory demand market, which is the AFPs. In the AFPs, going back to the first slide, they have mechanism of reserve in order to achieve the convergency of the interests of the principal, which are the members of the system, and the managers. There is a discussion right now in place in order to eliminate this reserve. So what would you suggest? What would you suggest in order to replace this mechanism of reserve requirement in order to solve the principal agency problem that this system embeds?
Yeah, it's a great question. So I'm just becoming familiar with the exact details of the pension fund system here. So unfortunately, I don't have an answer for you. I've been thinking a lot about this issue, but I don't quite know. I mean, the reserve is really interesting, but to be honest, I think about other settings for asset management internationally. It's pretty unique as an incentive structure. And so we actually don't have much theory that thinks about that particular aspect. So it's a little hard. I mean, so Juan Pedro Gomez is my co-author from IE University in Spain. And so I was actually talking with him about this yesterday and said, what models look like this? And so he said he didn't know, but he would go look at it and get back to me. And the good news is it'll take him about a week, but he's very thorough. So I'm sure in a week I will have at least the model, but maybe not the answer yet. So like I said, it's really unique as a component. I can see pros, I can see cons, but in the context of the broader discussion, I don't have an answer for you, even though it's an important one. Maybe somebody else here has answers? No? Okay.
Hello. I would like to know if you have any insight on the horizon in order to measure performance, because in the short term, I would say it's very difficult to differentiate between alpha and luck. Yeah. But in the long term, then it's very difficult to wait for many years in order to distinguish them from the other.
So let me give you two answers to that question, right? So as a statistician, we need long enough time periods to feel comfortable with our estimates, right? Now, markets, you can imagine more or less volatile markets. In the US, you need about 20 months of return data to feel really comfortable, generally speaking. We tend to, my guess is in Chile, with a little bit more volatility or illiquidity, however you want to think about it either way, you'd probably need something north of that, so maybe 24 to 36 months. So that's one answer. The other answer is, what do we see in practice, right? So one of the things they disclose in these compensation contracts is the time period over which performance is measured. So the most common number is 3 years or 36 months. You find often they'll say 1, 3, and 5. So that's, but then I think about the third-party sources like Morningstar, for example. They use up to 10 years, but they weight most heavily that first 3 years. So as academics, we tend to focus on 36 months, which, like I said, is probably too much for statistically not required for a typical mutual fund in the US, but that's the time frame we picked. It certainly aligns with third-party sources, it certainly aligns with what's done in practice for compensation in the US, and so we stick with that number quite often.
Hey, Richard. Hi. I really like your paper. I told you yesterday, and I would like to talk about transparency for investors, but I would like to you talk about transparency of the investment. Yeah. See, my point is that if you know if you know exactly what people are doing around, it's much easier to copy or do and have them do it. So it's very different, and I like. We talked yesterday that the conclusion about transparency is not too clear that transparency is so good in this case. Yeah. Because a benchmark actually is fully transparent. You know exactly the holes, but you don't know exactly. I talk about the signal. The portfolio didn't talk about the importance of the signal.
Yeah, great question. So, I mean, we do find with greater transparency, there's several papers that talk about copycat funds, right? So somebody discloses their holdings immediately afterwards, other funds. Now, so I'm with you. I actually think in this case, when herding is the concern, decreased transparency of the holdings isn't a bad thing, right? It may require managers to deviate. The problem is, I had a postdoc a few years back who, using machine learning methods, so in the US, we typically have monthly snapshots of holdings. And so for, not a fixed income fund, but think stocks that are traded maybe daily. And so he would use holdings one day, daily returns of, so I know what the stocks are at the beginning of the month, daily returns of the stocks themselves. And he can infer with unbelievably high precision your trades throughout the month. Right. So in some ways, even if you try and hide that information, I think there's statistical techniques now where managers can get it if they really want it. I've actually seen a couple startups now in the US that are, using the same technique, are tracking, inferring the returns of high profile managers, and they'll sell you those same returns for a lower price. So it's true. No, I'm with you. I hear you there. But no, I hear you.
But I'm saying here, but I'm saying if you want the peer pressure to work, you don't want
The supervisor too.
you don't want the parents to know, but
Yeah. And I'm almost 99% of the time I'm in favor of increased transparency, but this is one case where I actually think it makes sense. It makes sense, actually. So, great question.
I got a question for you and for Nancy. What do you think about not compensation, but information for regular people, non-institutionals? Should it be compared funds against peers or against a benchmark? And should it be regulated, especially for the media, which sometimes they are not so well versed in what they publish, so they do wrong comparisons?
Yeah, so regulating the media about that is really tricky. I agree. I think I have seen more misleading articles about investing in periodicals than I've seen helpful articles. You think, well, what's the ratio? It's like 1,000 to 1. So most of them really are shockingly bad at what they give. At the same time, when I think about what should be shown, so I had a conversation, the SEC just revised maybe 3 years ago, 3 or 4 years ago, the filings, the reporting documents. And so I interact with them a lot. So we talked about kind of things, and they were asking, well, what do investors need? And I said, well, I look at, so the way I think about it is I run a regression, and anything that has predictive power for future performance, those are things I think ought to be disclosed, right? So expenses, turns out, has the strongest predictive power for future, because it doesn't change, right? If I charge 1% now, I'm going to charge 1% in the future, most likely. And so thinking about it that way, those are the elements I think matter. Now, when I think about what you should compare it to, we often think about in finance opportunity cost, right? So if this is a fund, if this is an individual who can choose amongst a handful of funds, right? For example, in the defined contribution plans in the US. So my employer, the University of Virginia, has selected a subset of funds. And so I could compare it to funds outside, but that's worthless, right? Because those are not in my opportunity set. So the most logical comparison is funds of similar risk. So the other large cap funds I can choose from in that setting. So in that way, I think peers is often a useful comparison. Now, you could say, well, some investors, they're choosing between an active manager and a passive alternative. If that's the case, the passive alternative is more or less equivalent to that pure benchmark. So it depends on the individual and what their opportunity set is at the end of the day. From, what are they choosing from? Because that's the point of comparison they should see.
Let me add my own question. What about alternative assets? How do you get a benchmark for them? They're so illiquid, so little information.
So we found, so I think about hedge funds was the first, now private equity venture capital. We have these third-party sources, right? So Cambridge Associates, for example, has databases because they have all of these managers over time. Preqin, Burgess both have private equity venture capital. The HFRI, Hedge Fund Research Index, has the hedge funds. And so they are manager indices, right? Those are peer indices at the end of the day. Now, two important caveats about those. So number one is, often the product that is most easily accessible is survivorship biased, right? Because basically investors are thinking, what can I choose from? And if a hedge fund died last month, they won't include it. So you have to be clear you want. And I think the right measure is actually the survivorship bias free. So, and all of those databases over time, academics have complained enough that you can get the survivorship bias free version. So that's one. The second one with private equity and venture capital is even calculating returns, right? So, I mean, there's a really interesting paper that was published, I don't know, 5 or 6 years ago. Will Getzman at Yale and some others looked at inferring private equity returns from the limited partner cash flows. And so what they do is this trick, right? You know, I start a fund, 13 years later, 14 years later, there's a final exit. I know what the return is at the end, right? Because I know the money that went in and I know the money that came out. So think, you know, internal rate of return, I can estimate that. And what they do is they take staggered returns across different funds to infer yearly what the return is. So the Case-Shiller real estate index, if you ever use that, does the same thing. A house might buy and sell every 5 years, but all I need is a second house that was sold a year later and a third house that sold a year later, and I can infer kind of the annual returns. So now you need a lot of data, but actually to form expectations about the return and the risk for those alternative classes, you need an approach like that. I have talked you into submission.
Bueno, thank you very much. Very useful, and thank you everybody else. So we finish the session.
Such respect for regular job of time.
Thank you.
And I always